is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Yo, welcome to everyone joining us from live trading. Welcome to another episode of Benzinga Live. So for the past few weeks, we've had Ryan Pannell on from Kaiju to talk about their DIP ETF and some other AI investing tools and whatnot. Actually, this week, Ryan will be joining us, but kind of in a different way. So Ryan from Kaiju, as well as some of our people here at Benzinga, have been out at this Future Proof conference in San Diego, out in California. And Renato actually connected with Ryan in person for an interview there. So we're going to bring that interview here, pull that up here in a few minutes. Before we get to that, though, let's just go to our Benzinga Pro and do a quick rundown on what's going on in the market. I saw Apple trading a little bit lower today, bringing tech down with it. We'll check out the Qs. We'll check out Tesla after its huge rally yesterday. So without further ado, let me go ahead and get my Benzinga Pro pulled up. As always, if you guys want to check it out, pro.benzinga.com, free 2-week trial, no credit card needed. You really have no reason not to. Again, I'm always on here every single day looking, using these charts, using the different details pages that we have in here. That was easy. I just pulled it up and I didn't even bring up Apple and it was already up here. So that's what I wanted to talk about first anyway. So Apple shares are trading lower following a report suggesting, I'm going to mispronounce this name. Huawei is increasing its Mate 60 series smartphone shipment target by 20%. So, this was the concern last. Okay, no. So this is a Chinese company, Huawei. So this was a concern last week that China decided that iPhones would no longer be permitted for government employees to use iPhones as their work phone, and the stock went down. And like for Tesla, Apple, a lot of these big American tech companies, China is a huge market that they sell their products in. How many cars Tesla is selling in China, how many phones Apple is selling in China, those are big metrics that investors like to look at. Now with this ongoing kind of, I don't know, competition you want to say between the China and U.S. economy, it would make sense that if China tries to push more of its, homemade products in the same way that we in America would want to say, like, hey, like, let's stop, manufacturing everything in China. Let's start bringing some of these manufacturing jobs back to the United States. So everything you buy doesn't say made in China anymore. It might say, this actually does say made in China. It might say made in the United States. So it's the same thing. And I don't think, anyone who wants to try to make it out to be like, oh my God, big bad China is trying to promote more of its in-house, more of its smartphones that it makes domestically as opposed to importing them. That's not really, to me, a very sound argument, because obviously, again, here in the United States, we'd be, doing the same exact thing given the opportunity. So is the China growth story, is that a big concern for Apple? Sure. Is it going to hurt the stock in the interim? Sure. Do I think overall this is the worst thing in the world for Apple? No, I mean, I don't really think so. I think, there's amid this ongoing uncertainty between U.S. and China relations. I don't know. I haven't delved into it to see is iPhone really losing a lot of its market share in China, or are there just enough people that this other company, Huawei, can also sell a bunch of smartphones? I don't really know. I think that is something, if you were going to be making a big bet on Apple right now, it'd be worth looking into to see, okay, what is the status of the iPhone over there in China. But right now, I mean, Apple, for the past 15 years, since 2008, you basically could buy any dip on Apple and just make money, and it works out. And I don't really see any reason why right now would be the time that changes. So, obviously you buy a stock in the short term, it might go down, you might be down over a couple months period, but I feel very confident that, at least for myself, that if I buy Apple right now and hold on to it for, a few years, it'll be higher than where it is today. And that's how Apple, again, has been. If you look at this daily chart, just zooming out to 2000, just going back to 2000, 12 now. Any significant dip that this stock has had, like right here, it went from 25 to 14. This is all split adjusted. You could have bought it there. Boom, you made some money. Could have bought on this dip. Boom, you made some money. Could have bought it down here, made some money. Could have bought this dip, made some money. And you could tell me, okay, Aaron, but this time is different. And I could say, yeah, sure, it might be, but like in the long term, do I think again it'll still be higher than it is today? And the answer to that question will be yes. I think Apple is just a freaking monster. I think, any demand weakened in China, you could go anywhere else in the world and people are buying, Apple products. People like Apple products more than anything else when it comes to phones, laptops. And again, China might be different right now, but for the vast majority of the world, looks like the Qs are dipping a little bit. So let's go check that out over here. Let's go to a 5-minute chart so we can see some of this intraday action. Yeah, you can see right here, we're kind of making new lows of the day here, coming down around 373 and a half right now. Again, I mean, it's like similar with Apple. Like, I'm not really concerned by this not great movement in the Qs. We've been so hot in it all year that it's not surprising to see a slight dip in the Qs or Apple right now. So again, if you're a long investor, I wouldn't get too worried about these down days, but all right, let's go ahead and transition over. This is normally the time we would have Ryan Pannell on the stream, so let's go ahead and transition over to this video again. My man Renato, if you guys don't know Renato, he's one of the smartest guys we have here at Benzinga. He runs his own investment, the psychic investor, psych investor. I'll find it. But either way, Renato cannot speak highly enough of him as an interviewer, as a writer. So if you guys want to check out more of Renato's stuff after this video, I'll link to his newsletter in the chat. But without further ado, let's go ahead and bring that video on the stream. And then I'll be back in about, 20 minutes when this video is over, and we'll talk some more stocks. As always, if you guys got any stocks, any trades you want to check out in the chat, let me know. If you want to talk about some bets you made this weekend, fantasy football, whatever, just throw them in the chat. We'll get to it after the interview. So without further ado, let's welcome Ryan and Renato on the stream. What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody.
Greetings, Benzinga. We are here today at Future Proof in Huntington Beach, California. I'm here with Ryan Pannell with Kaiju, and we're going to do a quick interview today while he's in place of his usual appearance on Tuesday, right? Is that correct?
Yeah, Tuesday is the normal spot.
Yeah, normal. So in place of the normal spot on Tuesday, I'm going to ask him a couple questions, what he's doing here, and some of the great work he's doing at Kaiju. So let's get into it. Ryan, how are you feeling today?
Feeling pretty good. It's a little warmer than normally is the case when I do these things. I'm normally in my office, but nice to be out in the sun today.
Yeah, where are you coming from?
Coming today from Geneva.
Okay, gotcha. Is that where your office is?
That's where my office is, but Kaiju is sort of globally distributed, so we're 17 countries and 13 time zones.
Gotcha.
So everybody here who's here with us right now is coming from somewhere else.
Yeah, and you're pretty excited for this, right?
I am, actually. This is great. I mean, Future Proof is the world's largest financial management conference, and to be invited down to speak at it in a couple of days is awesome.
Yeah, what's the topic that you're going to be presenting on?
They've invited me to speak on a panel called Breaking Barriers, and it's CEOs that are innovating in the asset management space. So I'm representing Kaiju, and then we've got Engine Number One, Unlimited, and JP Morgan are also on the panel.
Gotcha. I know Unlimited, Bob, right?
Bob, exactly. Yeah.
That's got to be a good panel then, right?
Yeah, for sure. And Bob is, in my cohort. We're definitely quantitative and systematic on our side. So
yeah.
Bob and I holding up that side of active management and ETFs.
Gotcha. So tell me a little bit about your background, how you got into this space, right? Maybe where'd you go to school, and how'd you make your way into the space in the first place?
Oh God, I mean, it's a long and winding path, and school really didn't have a lot to do with it in the early days. So it's a career choice that came to me later. I was originally an equities trader, coming from a cryptography and theoretical physics background. I was an equities trader and then a portfolio manager for Europe's largest hedge fund, and I transitioned from there into a CIO of my own first fund, and then multiple funds, and then Kaiju grew, and here we are. And we'd always been quantitative in process. AI now for over half a decade, strictly AI. And that's, I mean, it's the flavor of the moment.
Yeah.
And the last 8 months have been fairly validating from that perspective.
Sure.
But, you know, when we were doing this, when we launched the first AI curated ETF, DIP, last December, you know, people were like, it was like we were practicing the dark arts. You know, I said that before, and that has not been available on the public fund side really at all. On the private fund side, it was the same conversation we were having 5 years ago, which was, you know, trusting largely a computer system to make endpoint investment management decisions. That can be disquieting for some people.
Yeah. So a lot of times, you know, people that are coming from these interesting backgrounds and then kind of moving into an area over time, really you kind of discover things in your career, right? So what are the big things that stand out, you know, that really manifested or resulted in you kind of pursuing this focus right now?
Well, I think I've generally been drawn to systematic processes.
Okay.
So even, you know, 2 careers ago in the art world, film and television was where I started as a very young person.
Sure.
But I was an early innovator in digital filmmaking technologies,
Sure.
capture technologies, you know, huge digital workflow systems. At the time, you know, film was still king, digital was starting to break out. And now, of course, it's how everything's done. But back then, it was a new thing, and a team that I was working with in the States and myself, we built the first multi-core system, 16 cores. We soldered our own daughter boards. You know, we put this thing in a filing cabinet because it just wouldn't fit in a case. We called it the Franken machine, and the workflow that allowed, digital filmmaking, digital from endpoint to finished product, seemed like a no-brainer to me, but it's tough for, you know, artists to let go of celluloid. And getting into trading, it's the same thing. You're coming in as a systematic trader, quantitative, scientific, and you're running headlong into fundamentalists, right? That are still, and these are 2 camps, you know, who will never meet in the middle. You've got, you know, quarterly reports and future projections, and what do they make? And on the quantitative side, we don't care what the company does. We're looking for signals in the noise, you know, patterns that we can exploit and predate on.
Yeah.
And that's always just sort of spoken to me, and AI is where that has gone.
Okay, gotcha. How do you position and sell kaiju to a, you know, prospective, you know, a person, right? How do you sell that company? You know, what's your sales pitch, right?
Well, I think it's different depending on whether you're going from the private side or the public fund side. On the private fund side, we've been doing this for a long time. So the credibility is easy because there's a demonstrated track record, right? These strategies have been in place for half a decade. Here are the returns. You know, our flagship fund is over 1,300% in 5 years, and that's information that we're able to share. On the public fund side, we obviously can't use any of the data on our private side to sell the public products like DIP. It's brand new. You can only use real-time performance, so it's been out since December. We're really happy with how it's been performing. It's had a stellar last 4 months, especially where that machine learning has really kicked into overdrive, and it's outperformed all of our benchmarks and comparables.
Yeah.
So, you know, you're really talking about building trust and credibility. The credibility just comes with time, right? There's no fast forward with that. There are some investment advisors that know us from the private fund side, so we get a little bit of a head start. The general populace, not so much. It's like, okay, great, awesome claims, let's see where they lead. Let's see it play out.
Yeah.
On the trust side, I mean, that always just comes from transparency. You know, so we try to be as transparent as we can with respect to how we do what we do and the guardrails that are in place to keep their assets safe.
Gotcha. So when you were starting this business, what were some of the big challenges that you had early on? And, you know, how did you overcome that and get to this place now where you are kind of like this global leader in these AI trading strategies?
I think the big challenge when we started was that the infrastructure wasn't available.
Sure.
Right? Like the off-the-shelf solutions that have been available in that last year, that continue to now be expanded on, didn't exist. So it was us building it proprietary from the ground up. And that's not just us, that was any shop that was using AI in the last 30 years.
Sure.
It was a huge, expensive, heavy lift.
Yeah.
I mean, like the Amazon Web Services bills could choke an elephant, right? And you have this enormous infrastructure that there's no guidance for. It's not like you can go out and say, hey, so we want to build this very complex underlying AI architecture. What's the best way to do that?
Sure.
Nobody's sharing that information, so it's a lot of first-person learning. So that was tough. The integrity of the data was tough as well. You're buying this from tried and true data sources, from Morningstar, from Zacks, from NASDAQ, from ICE. So, from SIBO, Opera, whatever it is, you're getting these quality sources of data, but they never provided it, I think, before in a way that was easy for an AI system to ingest. So there's this huge data sanitization process that has to, we have an entire team that just does that. Takes data, cleans it up so that the AI system can then use it. They're used to humans looking through this and realizing that columns full of null values, I can just ignore that. The AI doesn't work that way. It really has to be prepared for that. So that's changing. So the heavy lifting that we did, hopefully, and others like us, paved the way for it to be a little easier for others now.
Sure.
Certainly, we appreciate that it's easier for us.
Yeah. So how big is your team actually now?
We've got 40 people in total.
Got it.
Again, spread across the globe. We have a formal partnership with Imperial College in the UK and University of Zurich in terms of our AI personnel intake. That's been a big challenge, has been talent acquisition. There are no degrees in artificial intelligence. So, there will be very shortly,
Sure.
but currently you're looking for derivatives mathematicians, physicists, cryptographers, people that have, biologists, people who have used artificial intelligence and machine learning in their formal scientific processes, and now they're coming over and working in wealth management, in trading, in equities markets, capital markets, in liquid assets. So there's a learning curve there for them. Some of them have never traded before, they're not sure how these markets work, but they're experts in their field and in machine learning. And so, for us, that's been a great experience, bringing them on, developing those programs, and now we have a more fluid intake where MSc candidates come through, PhD, and then we're sort of a soft landing for them if they choose to stay with us.
Gotcha. So you've been working on these things for a very long time, and you're mentioning things that I don't hear a lot of other people talking, right? So do you have this kind of first mover advantage, right? And how do you kind of maintain this sort of position that you have already in the market?
That's a good question. I'd like to think that, being in early, we've ridden over the rocky terrain that a lot of people are riding over right now.
Sure.
Like it's not a smooth process, no matter how much support and assistance you have from an infrastructural perspective.
Got it.
So there are some hard fought and hard paid for lessons that I think most people learn. For us, 5-6 years ago, I watched an early iteration of our system drive like a busload of my money off a cliff. After 5 months of such shocking outperformance, we didn't know how to report it to our investors. It was like, they're not going to believe this. They're going to think we've gone crazy. They're going to think we're gambling. And we're high-fiving each other. We solved the market. It's all over. And then just off the cliff it goes. Now, that's not even close to possible with the systems that we have in place today, which are far more robust from a risk management perspective. But back then, so that helps us. What happened then helps us with what we have now. And you've got, talking about broad-based AI, you do have this disconnect between predictive AI and generative AI. Most of the conversations you're seeing people talk about generative AI with GPT and Midjourney and DALL-E and things like that are creating original content. Predictive AI is looking at historical patterns, current patterns, and trying to determine where a future point might be. So a little bit different.
So in terms of maintaining this position, talk to me a little bit about this whole concept of, responsible curation, right? What does that mean, and how do you ensure that, right?
So when we talk about responsible AI, we're talking about AI that has appropriate guardrails in place, where we've defined basically the hard landscape of what the AI is working within.
Sure.
You can argue that, I wouldn't call it irresponsible AI, but I would say that black box AI, which is let's say in our environment, trading systems that are black box. So black box AI in a trading environment is you have a system that's connected to a tradable asset universe. It knows how to trade, it knows how to long, short, options, whatever it's connected to. It understands how to make money. You give it a capital allocation and you say, go make money. Those systems historically have been responsible for the highest profit, but you're going to go through periods of like 70 to 90% drawdowns.
Yeah.
So you can't just use that for your average investor.
Yeah.
Whereas responsible AI is, you can do that, but you start to put up guardrails and controls so that you're like, okay, you can make as much as you can within this framework. Don't go over here, you can't do this, you can't like concentrate to this extent over here. Your P&L will be lower, but that's a more responsible application of the technology.
Sure, sure. Talk to me a little bit about mechanisms of reasoning and how does that all go into kind of strategy?
Right, so mechanisms of reasoning are sort of the collection of processes that we use in building strategies. So it's quantitative analysis, behavioral finance are the first two. There's nothing really unusual about that. Most quant shops go through that process. Quantitative analysis, the goal there is there edge? You think there's edge, you have this idea, is there edge and is there enough of it for you to build a trading strategy around? Okay, fine. And then you add the behavioral finance component to it. Behavioral finance is, okay, the organic changes to the market that may happen due to the human element, and is the strategy robust enough on the quantitative side to maintain its integrity when things change?
Sure.
The machine learning component, the AI component, makes that a dynamic process, right? So traditional quant strategies are static. You run the same thing over and over and over and over again, and when it works, great, and when it breaks, there has to be manual intervention. With the AI, that just happens seamlessly. So you take, for example, DIP's performance in the last, 3-4 months,
yeah.
and people keep asking, what did you guys change? We didn't do anything. We didn't touch it.
Yeah.
It just learned.
Yeah.
And that's where you get this substantial outperformance. And then, we add quantum mechanics. To be clear, you can't trade stocks using quantum mechanics. We use principles of quantum mechanics to help us predict future stock price. So if you have, at its simplest terms, if we both acknowledge that regardless of where a stock is trading right now,
yeah.
3 months in the future, it could be anywhere. Could be zero, could be $2,000 a share.
Sure.
The probabilities are more and more remote the further away from the concentration distribution that you have with that stock. It's possible but not probable. So there are principles of quantum mechanics we use to try to predict what the likelihood is that a stock will be exactly or close to here at this future point in time. So that's the four of them.
There's a lot of different people that have tried this similar things, or even just, forecast, distributions of forward returns, right, stuff like that. So talk to me a little bit about, kind of the drawbacks or things. You said you had challenges early on where you had this period of like outperformance, but down the drain, right? How do you really, what systems do you have in place to kind of hedge against those things today, right?
Right. So back then, we were looking at the strategy from the perspective of the candidate universe.
Sure.
So once we'd selected something, we're looking at, it was basically a single neural net per candidate.
Yeah.
And that was a little much for one neural net to handle. Now we run multiple neural nets per candidate,
yeah.
per underlying. So there'll be an upside, there'll be a downside, and then we have a regime classification engine, we have a regime change detection engine. They're all collaborating and coordinating within that specific underline. So Disney would have 4 neural nets
Sure.
for a specific strategy. And there are different neural net layers for different strategies. So let's say for one, it's got 4. Then you run the same neural nets at the industry level, the sector level, the broad market level, and they all talk.
Yeah.
So then you have thousands and thousands of neural nets all collaborating to try and determine, is what you're seeing happening at the discrete underlying level? That's just a problem with Netflix.
Yeah.
Is it at the sector level or industry level? Oh shoot, that's tech, or that's finance, or that's real estate, or whatever it is. Or is this a broad market collapse? So having that collaboration at that level makes it impossible for the multiple positions to just all go down the toilet.
Yeah.
Because the ARC, which is our AI risk containment system, will just off-ramp things that fall out of their risk envelope.
Sure.
And we didn't have that before.
Yeah. The reason I ask that is this is generally a new space to many people, right? So those are the questions that come up, right? Especially when you hear conversations, beyond markets, right? Just AI in general, what are the negative implications, right? Can AI take over the world? I'm just making things up now, but like you understand what I mean, right?
Yeah, absolutely. And that, that largely comes, as I've said before, it comes from AI being in our social consciousness for like 60 years now, right? I mean, how many movies were there from, the 50s on about machines going bad and then bad things happening, all the way through the Terminator series. I mean, we joke about that internally. When you take off too many controls, someone inevitably will say, do you want Skynet? That's how you get Skynet. But that's what's sitting there in the back of our mind, is that that's possible. Only the reality is it's not possible outside of a black box system, which contains unlimited possibilities, right? For an AI system to lose all your money, you have to give it the permission to lose all your money. For it to blow up the planet, you have to program it. Oh, by the way, you may want to choose to blow up the planet at some point. And if you do, this is how you do that. So if you don't give it that much in terms of freedom, it can't do it, right? So our systems, it's a specific trading strategy within an ideology. It has the ability, because it's based in machine learning, it can rewrite parts of its own code. But those things that it can change are how it reviews and weights different criteria we've identified as part of the universe. It can't just suddenly be like, you know what? I'm not going to do this option spread strategy anymore. I'm just going to trade long-term bonds. Like, there's no way for it to access the class or make those decisions.
So is this kind of where, educating the investor, these sorts of videos, right? Is that kind of where this comes in?
Yeah, very much so, right? I mean, we have to remember that we're like a year past the entire crypto implosion, right? Which was another, not necessarily new technology if you were already in the space, but people became suddenly aware of it. Over the pandemic, everyone was piling into it. There's this, yet again, a handful of self-professed experts saying, I know it's complicated and I know you don't really understand it, but don't worry, we got this, it's all fine. And then hundreds of billions of dollars goes down the toilet, there's global fraud, et cetera. Now, a year later, there's a new technology, there's a group of experts saying, I know it's hard to understand, but don't worry, we got this, it's all good. And you have an investor populace that's saying, yeah, I don't think so, not so fast. So the onus is on us to provide the educational component, to provide the transparency. You can't, and again, this is why we don't run black box systems, because with a black box system, you can't explain the investing decisions. It doesn't work that way. And so you can't you can turn around to your investors and say, I don't know why it did that, but it should be profitable.
Yeah, okay. So before this conversation, Scott was mentioning some stuff about ocean conservation. So do you want to talk a little bit about that and where AI kind of comes in?
It's something that I wish that AI could help with. It really can't right now, except to probably accurately model how catastrophic inaction would be. I mean, I've been involved in ocean conservancy for like 25 years, mostly because I like to breathe, and 70% of our oxygen comes from the ocean. It's not from trees, folks. If you think it's trees, it's not. It's mostly diatoms, which live in the ocean. So you kill the ocean, she's not going to breathe anymore. I'm not going to get on a soapbox and go on like a philanthropic rant, but maybe in the future there's some way that AI could be used to determine how we get particulate pollution, et cetera, out of the ocean. But sadly, I don't see an application for that. Best thing we could do is just try to clean it up ourselves.
All right. Okay. Back to kaiju.
Back to stocks.
So tell me a little bit about this kaiju kicker, right? The signal.
Oh yeah. So the kaiju kicker, right? So we do this thing every Tuesday where I try to come up with something actionable for your listeners. And I thought today we could talk about noise. Generally, just signal to noise ratio. That sounds really boring, but noise is something that everything from AI to if you're trading from home, this is part of your daily life. Noise in the news that you're reading. So you've got multiple news sources, right? Benzinga is a great news source. There's my shameless plug for you. But it really is. But if you've got, and some of these news sources are going to agree, and then sometimes, if you've got a very capable journalist, or if you have some erroneous information, you have one that seems to have independent information. Is that tradable? Is it something that you can do something with or not? And you might think that consuming the largest number of news outlets is the best, but it's just creating more noise for you to sift through. This is the same with indicators you might overlay on your chart. Oh, I got a 50-day moving average and a 200-day moving average, and I've got an Ichimoku cloud, and I've got yeah, great. And I guarantee that a bunch of those will contradict each other, and you'll end up in this paralysis state where you're like, well, but I got this. Same with the underlying indicators. You got volume, you got your stochastics, you've got RSI over RSI. Please, sweet Lord, don't have MACD. But these things, again, you're going to get favorable signals, and then one of them is going to be like a big red X. Yeah. So the more you add, the more noise you have, and the more difficult it is to make a decision. As a trader, as a portfolio manager, and within an AI system, right? So part of what we do is, yeah, fine, we fill the AI full of as much data as we can, but we try to filter out those data which are not meaningful to us. We don't trade commodities. So do we take in commodities data? No, because it's gonna contradict something that really it doesn't have any bearing on. I mean, the most famous example is something that I think Bridgewater ran, now probably 10 years ago, where they were consuming all of these data points, right? And it turned out that Facebook stock went up every time it rained in Buenos Aires. And at that point, that was true. So the early AI system was like, hey, I got a winner for you. You just buy Facebook every time it rains. You got a guy in Buenos Aires, it rains, you buy Facebook stock. Now, as a regular person, you know that that's the most idiotic thing you've ever heard, right? Yeah. They cannot possibly be correlated, right? Causation does not equal, or correlation does not equal causation. So 2 weeks later, sure enough, that broke and it's never repeated itself. Yeah. So there's a layer of sort of sanity that we have to provide to that, and that's about thinning down that noise. So my advice to the viewers is like, if you're looking at indicators, if you're picking news sources, if you're trying to build a trading strategy, try to get that to the fewest number of meaningful points so that you are not buried in noise. And that should be something that's actionable and repeatable. So if you do not need 12 indicators. If you have a favorite 3 or 4, you're probably good. You probably like 2 moving averages. If you even use those things, you're probably good. Don't use an Ichimoku cloud. I don't know anybody that makes money off that shit. So that would be what I would say today. It's like just try to condense the amount of noise that you accept to generate the signal you're looking to identify.
I've talked to a lot of really successful traders, and the one thing that I know, and that they even kind of mention, is you could take a really successful trader, their strategy, give it to someone else, and they'll just fail because they get that subjectivity kind of in there or whatever, so you get that noise and so on. So I feel that kind of reminded me of that. So,
yeah, absolutely. Yeah. Our CTO and I actually started when I was an institutional trader. He was a prop trader. Yeah. And he had his own strategies, I had mine. We would communicate in instant messenger, just sending ideas back and forth, but very different. And if either one of us tried to trade behind the other one, it like never worked out. We just had disparate styles. We saw different things. We reacted at slightly different times. Even though we could appreciate what each other were doing, it just didn't work. So that, to your point, I think that's been my experience as well.
Gotcha. Well, that ties it up for me in terms of the big questions. Was there something else that you wanted to mention before we kind of kick it off here and go enjoy Future Proof?
No, I think that covers it for today. I hope you enjoy your time here. I hope we don't get rained out. I hope I don't melt in this blazing hot sun, which I'm not generally used to. So, margaritas?
Yeah, sure, let's do it. All right, thanks everyone, and come join us next week.
Alrighty, guys. Hope you guys enjoyed that interview. Shout out Renato and Ryan for connecting in person. Again, at the Future Proof Conference. It's out in Huntington Beach, California. We had Renato out there covering. He spoke to a bunch of people, including Kevin O'Leary, as well as some other leaders in the crypto space. So hopefully, Ryan, I don't know if you're watching next time. Hopefully we're all out there in person. We'll get to do some more content together. But let's go ahead and get my Benzinga Pro pulled back up. Looks like we did get a little bump in the Qs while we were gone. As you can see here, we're looking at the 5-minute chart. The Qs kept dipping lower below that, right to that 373 level that we talked about, and then it has bumped up from there back up to 374.50. So Qs are we'll see if the momentum continues. I don't really know what to make of this right now. Some other top headlines, of course, we discussed the Apple news. Oil prices continuing to move higher. Let's check out XLE. You can see up another 2% today. I mean, guys, whoever's long energy right now, good job. The long energy traders are killing it right now. Energy just seems to be going up and up and up. Let's check out the USO, up another 1.8%. You can see here the USO, which this basically just tracks the oil price, ticker USO. It is, I mean, basically at its highest point since the COVID crash, besides this point, June 2024. So I don't usually trade a lot of energy stocks. Don't really, I don't venture into this world that often. What I will say is I check these charts a lot, how energy is trading, how things like copper is trading, how things like gold are trading, because it'll give you some insights into how the overall equity market, how the big dogs, how the investment bankers out in Wall Street are playing this stuff. Because if energy and financials and all these things are trading higher, typically you don't see those in times of recession. Typically you see energy trading higher when the economy is doing well, when demand for energy is higher, when people are traveling, when people are driving to work and whatnot. So that's why when you look at XLE and you see the big crash right when COVID hit, I mean, energy crashed a lot harder than other things during COVID because all those things basically stopped. Travel, people driving to work, etc., people taking trips. Now, all those things have come back, and they've come back hard. And energy, again, I mean, like, looking at this XLE chart, we're at a higher point on the XLE than at any point going back to 2014. You took out all these highs from 2016, from 2018. So, I mean, to me, this is significant. Like, you can talk about, recession fears all you want. Is this looking a little head and shoulders-y? Sure, it is looking a little head and shoulders-y. So, I think this XLE chart will be like the primary chart to watch right now, especially as people are concerned about the Fed continuing to increase rates, which would potentially, bring us to an economic slowdown and bring us to could be a mild recession. But again, as long as you see this, as long as you see XLE up 2% on a day, like, to me, that is not, you're not going to convince me of much recession talk while energy is trading so well. So again, I'm going to be watching this chart. If we do hit this point and this line right here, let me draw this line, acts as a resistance line, boom, and we move lower, then I think that will be indicative for, not just energy stocks, we're not just talking Chevron, Exxon, etc., but I think for basically all stocks, because I think a downturn in energy here would be indicative of some sort of economic slowdown to recession. And we can talk about, if that is the case, if there is a recession, what stocks we expect to get hit harder than others. I'm working on a thesis right now. Haven't gone through all the research yet. But basically my thesis is a short Uber trade, long Lyft trade. Kind of one of those pair trades. I like Lyft's value down here, just in terms of it's a lot more beaten up than Uber. And part of my investment thesis on Uber, or a short thesis on Uber right now, is as people do try to cut back on spending, to pay off their credit card bills, etc., cutting out food delivery, I think, would be like the first thing that people, the first thing, think about it. If you're ordering fajitas from your local Mexican restaurant, and it's typically $20 at the restaurant for those fajitas, and you get it Uber Eats, now all of a sudden you're paying like $35 with tips. So I think for a lot of people will understand, hey, if I'm trying to save money, if I'm trying to cut back and pay off my credit card debts, the easiest thing I can do is cutting out these food delivery services. And Uber makes about a third of its revenue as a company from Uber Eats. Lyft, I don't think, has as much exposure to the food delivery. So, like, people are still going to be needing lifts and rides from work or from wherever they're at in their social lives. But for food delivery, I think that we're going to see that come down. Jay, I don't really know what you mean. Nonsense. Energy is not the... I never said that energy is the economy. I was saying that energy tends to trade higher while the economy is doing well, and tends to take a hit. Not even when there's a recession, but then when there's recession fears. I mean, look at XLE here. June 22nd to June... What was going on here? This is when every single person basically in the markets, in the economy, was was saying we were heading toward a recession. And we didn't. And then energy bounced back. And so that was my point, is I think if people are pricing in a recession right here, you'd see energy trading lower. Not that energy is the economy. Nor do I really understand what Bidenomics is. I'll look it up. Let's see. What is Bidenomics? I've never heard this phrase. I mean, I think this part's silly about like our economy has added the most jobs because a lot of the jobs addition has just been like part of the COVID recovery. I will say the investments in like semiconductors, like the Build Back Better Act, and bringing a lot of manufacturing jobs back on American soil, so that we're producing these semiconductor chips on American land as opposed to outsourcing those jobs to Taiwan or China. I am in favor of, and I do think will do well for the American economy in the long run, because that's bringing high paying jobs to places like Arizona and other spots where you see these types of semiconductor plants popping up, and EV plants. A core tenet of Bidenomics is that targeted public investment can attract more private sector investment rather than crowd it out. Yeah, I think that's been true throughout American history. I mean, if you look at how America became leaders of semiconductors back in the day, like in the 70s and 80s and stuff, IBM, and really became the computer leaders of the world, all of that was backed by Department of Defense funding by the military, and it gave these companies like Intel and like IBM the freedom to go out and explore these new technologies, because they were getting government funding, and they didn't have to worry about essentially, hey, we need to just make as much money as we can for shareholders right now. They got a bunch of R&D money, research and development money from the government, which allowed them to do that. So there is a lot of evidence out there that shows that public investments in some of these things can actually create more private investments, and not the opposite, which a lot of libertarian or laissez-faire people would try to argue, is that by taking public funding or government completely out of it, you're actually better off, which again sounds great in theory, but hasn't worked that way in practice. I don't know. I mean, I don't, from like a neutral, objective standpoint, from what I've read, that the Biden administration has actually done like a decent job of like buying oil when it's cheaper to beef up the reserves, releasing the reserves when it's expensive to help bring gas down. We actually wrote an article about that here on Benzinga. Yeah, like the oil trade of the year, people are giving him credit for, saying that how the White House managed, how defanged Russia and OPEC with the strategic petroleum reserve. Gas prices were a major story in 2022, Russia's invasion of Ukraine. Instead, it appears the U.S. government, the oil trade of the year, releasing 180 barrels of crude oil from the reserve between March and the end of this year in an effort to blunt the effect of rising prices. The U.S. government appears to have made about $4 billion as prices have fallen dramatically over the course of the year. Selling when crude oil prices were high, the U.S. captured billions in value. By one widely used measure, the price of crude oil in Texas peaked at around $124 a barrel in March, and the average price during the SPR sales was about $96. Today, that oil costs just $73 per barrel. So basically, they depleted the oil reserve and then went back and started buying more oil as it got cheaper. I mean, Jay, I am not a big I just don't think I from like an objective statistical standpoint, these are numbers, right? These are just facts. Don't care about your feelings, right? I'm not a big Biden. I didn't vote for Biden. I'm not a big Biden guy. But like this is literally just facts, and talking about they were releasing oil when it was more expensive, and as it got cheaper, bought it back into the reserve. Um, what you just read is totally false. Okay, Jay. All right, Jay. Again, like this is why I don't really, I can't ever like talk about this stuff because people, if you can't, we're at a point in time where just numbers are fake and anything that you don't like is just fake. I mean, look, like, you know, it could come from the Wall Street Journal. It could come from, I could pull it up from any different source, any different outlet. It's not going to change, Jay. You're just going to still say, oh, that's fake. The numbers are fake. Like, then we can't have like intelligent conversation or debate. If at any point any numbers or anything is talked about, it's just, oh, those numbers are fake. And again, we cover this on Benzinga, so it's, you know, here's from the Benzinga article. So I mean, like, you know, it's a little frustrating, I guess, Jay, to hear you say that like some of the work that our people are doing is just fake or totally false. Again, when it's backed in numbers, and again, facts don't care about your feeling. You can not like it, but it doesn't make it not true. And again, if you want to say those numbers are wrong, then fine. Then find me some different numbers. Find me some real numbers. What was the price of oil at when they were releasing the oil reserves? And then what were they at now? And what was the impact on gas prices during that time? Give me back all those numbers, Jay, and then tell me, you know, how fake or real it is. I mean, it's like if a company like Apple blows out earnings and the stock goes up 10% and you had puts, you can sit there and say, oh, those earnings were fake. Those numbers were fake. The stock shouldn't be up 10%. Well, it doesn't matter. Whether you think the numbers were fake or not. Dude, Jay, again, I can't, we're not gonna, I'm just dropping it because it's not worth it. Again, if your response to something is that's fake. What up, MD? How we doing? Yeah, 100%. The White House, whoever the White House's PR person is, whether it's Jen Psaki, whether it's I forget Sarah Huckabee Sanders, whoever it is, whether it's for Trump, Biden, right, left, like their job is to literally promote the White House and say, hey, look at how great of a job we're doing. Of course that's true, but that's not what I'm talking. Like, okay, maybe I shouldn't have pulled it up from there, but from the Washington Post. From, you know, the Wall Street Journal, a right-leaning outlet, saying that stuff. Again, I'm not, you know, it's not just from, yeah, Jay, here, you can post them here. You can send them to me at aaronbree@benzinga.com. But I mean, if, you know, we'll see if, again, right now, yeah, it would cost more to refill those reserves right now with oil at the prices of, you know, we'll go back to the USO chart. This is the highest point oil's been since June 2022, and that's when we were releasing those oil reserves. So, you know, if we here, let's do SPR. Here you go. Here we go. We got it pulled up now. So here's the, you know, here's our stock of crude oil. Here's what we were talking about back in 2022 when we started depleting those. Again, for all accounts and measures, maybe it was just a complete coincidence that gas prices also happened to start dropping right when we started releasing these. And okay, so we're still at about 350,000 barrels of the thing. So it doesn't look like the reserve's completely depleted. It looks like we have about half of the oil in reserves that we did about 2010. I mean, but if you look throughout here, we were depleting the reserves here. And I think someone else was in office from, you know, 16 to 20, I believe. And looks like we were depleting, we were selling some barrels of oil out of the reserve there as well. Which I'd be curious if a lot of the people that are, you know, up in arms about it now were saying anything about it then. Oil drops off a bunch at 350 right now. So yeah, I mean, I think would I want to start stocking back up on oil right now when it's at its highest point that has been in the past like 2 years? No, probably not. I'd probably want to wait a little bit. Maybe start releasing more barrels out of the reserve. The U.S. government, like, we got a lot of money. I don't know if you guys know, but like every single year we increase our deficit to pay for, to pay for defense contracts, to pay for types of things. If we need more oil, guess what? We can afford it. So I would not be in favor of starting to buy more barrels of oil right here with oil price at their highest point. Again, you can see right here, boom, we're at the lowest point in our reserve going back to 1983. But again, how much oil we have in our SPR reserve isn't what the daily average American cares about. What the daily average American cares about is how much does gas cost at the pumps and how much are their energy bills. I mean, again, Jay, from all neutral, objective standpoint reporting from the Washington Post, from the Wall Street Journal, and again, those are I think most people would consider Wall Street Journal a right-leaning outlet, have all said that the oil moves that Biden has made, politics aside, was helpful and good. Now, that's right now. In a year, it could look like, no, that was terrible. Of course, like, things can change. Like, it could look like a terrible move, but right now, I don't know how you could look at what was done and say that was a poor move. Again, just to recap, we were depleting our oil reserves at when oil was like up here starting in 2022, and then as oil prices went down, so actually made money off of it, and then we're able to also help bring gas prices down. All right. Any what do I have to be kidding you on, Jay? About Washington Journal being a right-leaning outlet? Oh shoot. Apple's coming back up too. I said before we went to the Kaiju interview, like I honestly think you can just buy. Things aren't that simple, but with Apple, I feel like it is, that you can just buy dips on Apple and just make money. I might set up like a trading bot or an investment bot to just, anytime Apple's down like 3% from its highs or whatever, to just put a buy in for it. This thing's always going to come back. Always. Not investment advice. All right, Jay. Like I said, email me some art. Show me this. I'm from the show me state. I'm from the show me state. Then show me how bad it's been. Give me some numbers, baby. Give me some numbers. All right. Any other stocks people wanna check out in the chat? Also, speaking of oil, I did see this, which was cool, a week ago or so. Let me see if I can find it. China peak oil demand. China's gasoline demand peak nears. Hold on. China's Sinopec says peak gasoline demand has already passed. China's EV boom has prompted oil giant Sinopec to adjust its oil demand forecast, saying peak domestic gasoline demand has already passed and it's going to be downhill from here. If accurate, the repercussions will be global, considering China has long been the biggest growth market for refined oil products. So basically what this means is that as China's economy has grown, naturally more and more oil is needed in China to keep these things going. So demand has gone up and up and up every year as China's economy has grown. But then now that EVs have come in and people are buying less, cars, buying less gas, whatever, that demand peaked. So the demand for oil in China was higher in 2022 than it will be in 2023. And Sinopec is basically saying every year subsequently from here, less and less oil will be consumed in China. So what does just classic economics tell us is that as demand goes down and supply stays the same, price shall go down. So that doesn't necessarily mean that demand or that prices for oil will go down because demand is peaking. Because as we know, oil isn't really, it's not really a free market per se of supply and demand because the OPEC countries, the countries that produce and export oil, will limit production to try to elevate the price. So, Mario, you'd have demand dropping, and because there'd be a free market, you'd have to have people say, okay, we'll have to drop the price to meet the demand drop in, or less people would start producing because the price isn't as high. So the incentive to produce isn't as high. But with oil, since it's kind of like that cartel system where the countries will get together and say, hey, demand's dropping heavily in China. We don't want to have to start selling oil for $50 a barrel. Let's just start cutting production to try to meet that demand. Yeah, that was from let's see. This was from here we go. The US Energy Information Administration. EIA.gov. You can check that out. Oh wait, shoot. I'm sharing y'all just like a blank screen right now. It's not good. Not good YouTube. Alrighty, y'all. It is a little past noon, so it's past our time. I don't know. I mean, again, my take on the oil thing is like oil prices are high. Good news for the economy. Oil prices start to dip. Bad news for the economy, but good news for spenders. I agree, Porta Banza. And I'm gonna look into it a little bit more, just about what's going on currently, because I know there were some like permits that they said. It does look like, just from a quick Google search, there's some headlines like, for example, from the Telegraph, it says Biden has cynically run down the U.S. strategic oil reserve to buy votes. Which, okay, like, that might be true. That he's basically just saying, hey, to hell with the oil reserve. Let's go ahead and just like make sure gas prices don't get too high. Otherwise, people aren't going to vote for me. Which, like, that could be true, but like I said, like, the average American doesn't care about how many barrels of oil we're holding in our oil reserve. They care about gas prices. So, like, I don't think that's the dumbest move in the world. Of course, from like a national security standpoint, you want to have a certain amount of oil in the reserves. But my point is that, like, we will always be able to buy more oil if needed, right? What happened when the stock market crashed during COVID? The Fed pumped like $500 billion right into the market. What happened when COVID hit and a lot of people lost their job? People weren't working. We sent out billions of dollars of stimulus. What happens every single year in Congress? They vote to increase the deficit to pay for more defense contracts and more, funding to the military. There's always more money. The U.S. government, like, it's not a finite amount of money. So if the oil reserves was zero tomorrow, guess what? We'd be able to buy more oil. Unless there was like a global war and then like the, OPEC countries were really holding out on it. Yeah, that's a problem. Then that'd be a problem. But I'm not going to get worried about that until that, happens. Oil prices are surging again, but this time Biden has way less ammunition to bring them down. See, this is true. Jay, this is true. That at the first time a year ago in the summer when they started depleting the reserves and we had 750,000 barrels of oil, and now we have half of that, he can't do that again. He can't do the exact same thing again. That's true. But to go back and say what he did last time didn't work out or wasn't good for the American people, I think is just very tone deaf and very just very partisan to say. And again, I'm saying this as someone who I won't be voting for him again. I didn't vote him for the first time. Won't be again. Like I'm not like a Trump's tax law could benefit Biden's efforts to protect wildlife from drilling. I don't know. All right, so we're gonna have to get into some of these. Biden's attack on the oil supply. I think National Review is kind of maybe not the best source. Let's see. Ground News, National Review. I don't know. All right, guys. 12:06 12:06 p.m. on the East Coast. Let's go ahead and wrap up for the day. We will be back on Thursday with more Benzinga Live. Until then, we should be live on Swing Trade later in the day. Make sure to catch us up. Yes and no, Jay. You know, I mean, we increased our deficit every year for what, 20 straight years. Never saw a significant increase in inflation from there. So you're not really going to sell me on the idea that just increasing the deficit alone makes inflation go up. Because again, we saw that happen for 20 straight years as we increased the deficit, and inflation never really picked up. It was only when, in fact, we had some deflation at certain times. It was only when, we had a global pandemic like COVID and supply chains got crunched and we sent out big stimulus checks to everyone that we then started to see, inflation pick back up. So there's a lot of evidence from economists that say that classic idea of just increasing the deficit alone is going to increase inflation isn't necessarily true. And it's also one of those things, I mean, like the whole like deficit hawk thing. You have people who, complained for 8 years straight under Obama that we were increasing the deficit too much. And then as soon as Trump came in, guess what? We also continued to increase the deficit. I mean, that's fine, Jay, but like, I literally have not said anything that's not a fact. We increased the deficit every year under Obama and then again under Trump. I don't like either of them, but I'm okay with increasing our deficit. That's what I'm saying. Like, because it doesn't just straight up lead to inflation. You can disagree with that all you want, but then how did inflation not go up from 2008 to 2020 before COVID for those 12 straight years? How has Japan increased their deficit every year for 30 straight years in inflation if that's the case? So again, like I'm wrapping up anyway. So either way, Joel, you got those links. Thanks, party, for tuning in. But peace and love, y'all. We'll be back on Thursday. Till then, stay green. Happy trading.